It's no secret that the markets are in a strange position today. We've just seen the entire world go through the first recession of its kind, one dictated by government restrictions and lockdowns rather than unemployment and consumer sentiment. For the first time in history, it wasn't a case of I can't find somewhere to work, but the government won't let me work. And as this was a completely unique crash or recession, there was also a unique government response, one that has led to a whole myriad of other problems. Government spending, stimulus checks and asset purchases have driven us right back into a bull run, one larger than we've ever seen before. New asset classes have emerged that are now worth trillions of dollars when just a couple of years ago they didn't even exist. Our economies have never before been so reliant on financial derivatives and debt, and a worrying trend has been identified. That is, the relationship between a recession, a crash, a depression even, and the explosive growth of financial markets and asset prices. The truth is, a second Great Depression is knocking on our door right as we speak, and confidence in those who are supposed to fend it off, our central banks and our elected officials, has never been so low. So we're going to look at the state of the economy today, the similarities between it and the Roaring Twenties and the Great Depression of the 1930s, and just what might be the straw that breaks the camel's back. But first, make sure to leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for my own personal portfolio. So if we are to try and work out whether or not a recession is really on its way, then we need to look to the past and see if there's any metric we can look to that has a strong relationship with recessions. And luckily enough, there is something, and in short, it's debt, derivatives, and the disconnects between financial markets and the real economy. The easiest way to explain this, and with every piece of nuance thrown out of the window, is to think about whether financial markets are driven by the actual underlying economy upon which they're built, or speculation, derivatives, debt, and basically gambling done by middle-aged men on computer screens. Basically, you look at the difference between the real economy, what real people are buying and not buying, the earnings real businesses are making, and financial markets, options, futures, derivatives, crypto, NFTs, and luxury goods as well, and the greater the disconnect between these two sectors, the more the financial markets are running in their own world, with seemingly no relation to the economy upon which they stand, and that can be a really useful indicator to see if we're nearing in on a recession. The purpose of a stock market isn't to allow banks to make bets on the future of green technology, or to allow George Soros to make another $1 billion. Its purpose is to allow businesses to access capital, to finance growth or restructure themselves. Its purpose is to allow people to allocate their capital in efficient ways to get a return on their investments. The value of an investment, a bond, a stock, or any other asset or security should be determined by the invisible hand of the market, not by gamblers, speculators, and market makers. And when valuations start to go awry, when they stop making sense, well, that's one of those indicators that a recession is just around the corner. When these mispricings become too large, when certain conditions are met or triggers occur, the overvalued markets correct themselves, and that's when we see a crash, a correction, a recession, or even a depression. Now, the greatest mispricing of all time, that led to the greatest recession of all time, the Great Depression, had far more similarities to today than you probably realize. And by looking at the past, by looking at what is similar between the past and today, and considering what the outcomes were back then, maybe, just maybe, we'll end up with a better idea of what's going to happen today. Now, thankfully, I haven't had to do all this legwork myself because truthfully, this would take months if not years to put together in its entirety, but Mike Maloney from the YouTube channel Gold Silver has actually compiled a huge list of similarities between the Great Depression and our markets today, and he put it into a book and even gave us a live stream of his breakdown of that part of his book, both of which I will link down below in the description. So first of all, thank you, Mike. But what are these similarities? Well, there are lots of them, and as of right now, it really starts with the Roaring Twenties, the bull market that followed the end of the Great War and the bubble that led right into the Great Depression. But really quickly before we get to that, a quick message from this video's sponsor, DataCamp. Now, if you're like me, you value learning new skills and investing in yourself, then you need to hear about this video's sponsor, DataCamp. They are dedicated to teaching everyone valuable skills at their own pace, helping both beginners and pros to stand out professionally. They are an online learning platform that makes acquiring data skills easier and more convenient than ever before. They have over 350 different data science courses for people of all different levels, designed by top experts in the industry. If you've ever wanted to learn credit risk modeling with Python, or maybe portfolio risk management or financial analytics, or any one of the hundreds of other courses available that can help you become a better investor, then I seriously suggest you check them out. If you're literally brand new and maybe a bit overwhelmed, then take DataCamp's free assessment and get personalized learning recommendations. The learning experience is also gamified, so you get XP points when you learn, helping to make it really fun. It's all run directly from your browser, so you don't have to download any software, making it easier than ever to access. Unlock new career opportunities and become data fluent today. Use my link in the description box below and check out the first chapter of any DataCamp course for free. Now, throughout the run-up to the Great Depression, the Dow Jones had some pretty incredible gains, and optimism not only about the 1920s, but the 1930s as well, was monstrously high. President Coolidge egged on the bull market. He saw the soaring stocks as an endorsement of his presidency, so he championed it. He took credit for the successes and did everything he could to keep consumer and investment sentiment sky high. He came out and said that the economy had never looked stronger, that the 1930s would see this trend continue as the United States had entered into a new era where developed financial markets and innovative new technologies like radio would allow business to thrive forever. This, to me at least, seems eerily similar to what we see today. We have politicians and policymakers who care more about the markets than they do the economy. They egg on asset prices and celebrate when they continue to inflate, even if they're inflating under unusual circumstances. And again, politicians today love to take credit for the markets when they rise, which we saw under Trump, but under Biden and Jerome Powell as well. Making your voters rich is a great way to be a popular statesman, even if there's no real substance to that newfound wealth, and even if that wealth will just disappear further down the line. In the bull market of the 1920s, the Federal Reserve kept cool loan rates artificially low, which helped to boost the bull market and expanded the money supply and encouraged investment. Now, the best way to explain cool loan rates is to basically consider them interest rates for margin accounts today. Basically, the Fed kept margin cheap. They made sure interest rates for those who wanted to borrow money to bet on the stock market were low, which encouraged people to take out margin and buy stocks, which forced price upwards by increasing demand, and it boosted the bull market further. This debt was also essentially printed out of thin air, as is so often the case when it comes to fractional reserve banking. So not only was this money cheap, but it also represented an expansion of the money supply, or as it was simply known back then, inflation. Of course, there are lots of similarities between the 1920s and the 2010s here again. Margin debt is and has been incredibly cheap for years now. It is not unheard of for relatively normal people, albeit with good credit scores, to have margin at a rate of 1%. Now, in a normal inflationary environment, where CPI sits at 2 or 3%, then that's already a great deal, and most people would jump on the opportunity to acquire some debt and invest it. But then when you consider the fact that over the last year, inflation has been sitting above 5% for months now, and is now actually touching on 7%, real interest rates for margin debt are something like -6% a year. That means that even if you don't invest the money, or even if you do so extremely poorly, it would still make sense to take out margin and use it on the markets. After all, it seems almost impossible to lose. The markets are booming and rates are low. When has there ever been a better time to be irresponsible? Now, of course, in recent years, just like in the 1920s, we've seen a huge expansion of the money supply, and with that huge inflation when it comes to asset prices. The similarities between the economic environment that led to the Great Depression and today seem to be growing, but it doesn't stop there. In the 1920s, the crazy high investor sentiment led to the belief that there was little to no chance people wouldn't be able to repay their loans, which led to the deterioration of outstanding credit. Basically, because the markets were so bullish, companies were so successful, and people were feeling so wealthy, they all thought that they could repay their debt no matter what happened. So they took out riskier and riskier debt. And because the banks thought the same thing, they gave out this riskier debt as well. Now, there are similarities between this and the markets today. Levels of debt in the world today are soaring by pretty crazy amounts according to pretty much every metric. And we are seeing people pushing themselves to take out bigger and bigger mortgages to chase rising house prices, as most people believe that the housing market is only going up and they'll always be able to make their repayments. But the really eerie comparison between the 1920s regarding the quality of debt is with the run-up to the 2008 housing market crash, where banks really let loose and almost anyone was able to take out a mortgage with pretty much no problem. Some people took out mortgages in their pets' names. Some people didn't have to put any deposit down, and some even took out mortgages above 100% of the value of the home, meaning they went in to buy a home with $0 and came out with a house and an extra $20,000 as well. The deterioration of the credit markets is now infamous thanks to films like Margin Call and The Big Short, but no one really talks about the fact that the exact same thing happened in the 1920s and that it was a major contributor to the Great Depression. Now, I've already mentioned that the stock market was booming, but by just how much? Well, in 1927, the Dow increased by 33%, and in 1928, it increased by another 50%. Now, you might think that everyone got rich from this, but in reality, it was mostly only the wealthy that had any major exposure to this booming market, so that is who got richer, just like we're seeing today. The market boom that we've been seeing since the pandemic has made more billionaires than ever before, and more millionaires than ever before as well. But most people today still aren't investors, and even if they are, maybe they managed to put away $100,000 after working for 20 years, and so their gains are limited, just like they were for average people in the 20s as well. Now, because the market was booming, people got FOMO, fear of missing out, so they abandoned safer, more reliable investments in favor of ones that had a chance of making you a millionaire overnight. People shunned bonds and other fixed income assets and instead took to speculating, just like we're seeing today. Risk assets got more popular and widespread, but in this example, the present is far, far worse than the past. The growth of the crypto industry and the subsequent growth of the NFT market is probably the most speculative market to ever exist, where the vast majority of tokens, coins, and digital artworks are bought with the sole purpose of being sold on at a later date for more money. Now, I say this as someone who has money invested in crypto and who believes in the technologies behind many of these tokens like blockchain and proof of stake. But the fact that I think that the industry will grow into something huge and world-changing in the future doesn't mean that's what it is today. The reality is that if you go on any forum or watch any YouTuber that talks about crypto, and you're going to be hearing the same thing over and over again. The next 1000x coin, the next Floki Inu, Shiba Inu, or Dogecoin, the next millionaire maker. Many of these projects have some utility, even more have the groundworks and technology present that would allow them to have utility in the future. But even the most useful of them all, the Ethereums of the world, they are still mostly driven by pure speculation and the greater fool theory. The crypto market, whether you like it or not, whether you admit it's true or not, it's full of risk-on assets, and the growth of risk-on assets in the 1920s was a prime indicator for the bear market that was to come. Now, back in the 1920s, the SEC, the Securities and Exchange Commission, and financial regulations in general were incredibly weak, which allowed the wealthy, the smart, or even just the immoral to profit off of shady doings. Pump and dump schemes were widespread and went completely unpunished. A group of wealthy investors would buy up large positions in small stocks that went mostly unnoticed. Then they'd spread rumors about deals to be done, opportunities for the company to succeed, and once the price had risen by 200 or 300%, they'd cash out. Nowadays, this is illegal, and if you tried to do this on Wall Street today, you will probably get caught, fined, and maybe even thrown in jail. But in the world of cryptocurrency and unregulated digital assets, it's a whole other story. Now, forgive me if I don't want to just list off every single crypto scam or rug pull out there, because we would literally be here for days. If you want to see just how prevalent the world of Ponzi schemes and downright fraud is in crypto, then look no further than CoffeeZilla, who has built a career for himself exposing these frauds. There are coins like Ethereum Max parroted by the Kardashians in exchange for huge undisclosed payments. There are schemes like the Squid Game token, whose only purpose was to prey off people's desires to get rich on the next 1000x token, only to rug pull the crypto and take every penny that was invested. There are NFT drops being shilled by D-tier celebrities in exchange for thousands of dollars. There are even phishing scams where people pose as Elon Musk going on a philanthropic mission claiming to send back 2 Bitcoin for every 1 Bitcoin you send in. The type and breadth of these scams is huge, but the story is always the same. A lack of regulation from the governing authorities, a lack of consequences for those who perpetrate these scams, and an awful lot of money to be made by those who don't care about the pain and anguish they inflict on others. Here again, I'm afraid the present day is looking increasingly similar to the 1920s. But once again, it doesn't stop here. The similarities continue to emerge. In the 1920s, the market was so quick, so exciting, and so popular that cruise liners had brokerages added to them so that people could still trade their stocks while they took the week-long voyage between Europe and North America. But where's the relevance of that today? Well, it's to do with the fact that services were provided to make it easier than ever to trade, because of how popular investing had become. Now today, it has literally never been easier to trade, as we can quite physically pull our phones out of our pockets and buy a share from pretty much any public company in the world within a few moments. This has been driven along by companies like Robinhood and Webull, who have made accessing your investments quickly, easily, but also cheaply their entire business model. This represents euphoria in a market, just like the brokerages on cruise liners represented the same thing in the 1920s. Of course, the thing you were probably expecting me to talk about for this entire video, but which I've specifically avoided, is the old adage, supposedly said by Joseph Kennedy Sr., JFK's father no less, and that is, you know it's time to sell when the shoeshine boy gives you stock tips. It's an infamous saying for a reason. Not only because it prevented JFK's father from going bankrupt with the rest of the country during the Great Depression, but also because it represents retail investors who almost definitely have no idea what they're doing and are just chasing the trends and participating in the hype and the weird Dunning-Kruger effect where they think they're geniuses because they're investing during a bull market, but in reality, they represent the peak of a bubble, market euphoria at all-time highs, and the investor who thinks stocks only go up. There are a million different modern variations on this saying that apply to today. They range from Uber drivers and meme stocks to DJs and cryptocurrencies, but they all tell us the same thing. Retail traders, crypto or NFT enthusiasts, meme stock chasers, they all represent overwhelmingly high investor sentiment, a complete lack of risk mitigation, and the peak of a market bubble. There are even more similarities between the bull market of the 1920s and today than I just mentioned, but I can only recount so many before this video gets boring and you stop watching. I know there will be people down below in the comments section claiming that I'm comparing a bull market to a bull market, so of course there will be similarities, and this doesn't even remotely suggest that a correction, a recession, or even a depression is on the way. But the truth is that bull runs always end, and when they do, they are replaced by bear runs as the market returns to equilibrium and asset prices return to their intrinsic fair values. Risk tolerances reduce and fear grows. The markets just tame themselves. Of course, we can't compare the Great Depression to today because we aren't in a depression today. I can't look at what happened in the 1930s and compare it to what will happen in the 2020s because I don't know how the next recession is going to look. For that, we just have to wait and see. We just have to be patient and careful, and once the coming bear market has ended, then we can look back in the past once more and try to see what we missed this time around, what we got right, and how we can use that to do well in the future. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts from our own personal portfolio. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. There's also a link in the description to BLOCKFI, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.